From New York City for our viewers worldwide, I'm Matt Miller. A revision down for GDP and personal spending. The countdown to the open starts right now. We begin with the big issue. Can rising bonds trigger a stock rally stall?
We're now at a level of bond yields where rising yields from here are really going to weigh on all asset classes. And so we find the impact of rising bond yields on equities as being a function of the level. And now we're at the sort of levels where it begins to matter. But also importantly, the speed of adjustment. The faster any rise in yields, the bigger the impact on equities. And what we are seeing is reasonably quick rises again in the very recent past. And I think given the valuation of equities, this is going to be a sort of steep speed bump.
Joining us now is Jack Janasiewicz, portfolio manager and lead portfolio strategist at Natixis Investment Management Solutions. And Jack, really interesting setup. We have a little bit of a turnaround today because yields have come back off a little bit. Futures are down, but they're climbing a little higher after we got that GDP revision, personal spending. What do you think of the economic setup that we have right now? How slow does this growth look, and will disinflation come back?
So I think there's a couple of things worth noting here. I think the risk going into this GDP print this morning were the revisions, right? Are we going to see some significant downside revisions to the growth backdrops, specifically with consumer consumption? And might we see some significant upside revisions to the personal consumption expenditure price index? And we really didn't get either one of those. So I think from an inflation backdrop, gives us a little bit of reprieve in here, knowing that things aren't necessarily growing at a pace that's inflationary, on top of the idea that inflation is still at least moderating. I think the bigger picture trends are still intact. Modest growth. We're seeing a normalization in the labor market. That's putting downward pressure on wages. I think over time, we're going to continue to see that inflation level continue to drift back down towards the Fed's 2% target.
Even the surprise on the upside for inflation that we saw last month really didn't drive markets down, right? We continue to hit new high after new high. Why do you think that is in terms of stocks?
So, I think when we look at what's been driving, for example, the core indicators within CPI, it's really been three indicators, right? Three line items. It's been shelter costs, it's been motor vehicle insurance prices, and it's been healthcare service costs. And if we think about whether those are demand driven or not, those are really, I think, supply related issues. So further increases from the Fed aren't necessarily going to address those kind of issues that are really accounting for almost all of the increases we're seeing in core PCI or CPI. So from a perspective of the Fed, which has the dual mandate, if you're going to continue to raise rates, you're probably going to put pressure on the labor side of that dual mandate, which is full employment. And I think the Fed's loath to do that. So again, back to three line items accounting for everything, not much that I think higher rates are going to do there. Just buy some time, higher for longer, or at least a little longer in here, I think is what we're looking at. So
Jack, what you're saying is the market knows that the bar for raising rates is much higher than the bar for cutting rates at the Fed.
And that's a very important point to make here, because if you think about how sort of offside the market had gotten and looking at it through the idea of how many rate cuts were priced in, for us to become incrementally more hawkish, I think you have to start talking about rate hikes. And at the last FOMC meeting, Chair Powell had plenty of opportunity to talk about increasing rates. Even during the Q&A, I got asked questions about that, and he avoided it. So I think that's spot on. The bar for hiking rates is materially higher, even though the bar for cutting rates is still high. And that's a key differential here when we think about how hawkish the market really is.
All right, Jack, hang on a second, because I want to ask you about where you see opportunity in this market. But before we get to that, I want to get over to Michael McKee. He's our international policy and economics editor, and he joins us now with the details of really the revisions and the spending data that we got out today. Mike, what do we see?
Well, we don't see a lot of change, Matt, and that may be why we're seeing some good reaction in the bond market. It doesn't suggest that the argument that has come out about whether our star is higher or not is necessarily relevant. We did see almost no change in jobless claims today, 219 up from 216. It shows companies still holding on to workers. We'll see next week if they're still hiring a lot of workers. And then the GDP numbers. Now, keep in mind, this is 2 months ago. The first quarter ended at the end of March, but at that point, GDP was rising 1.3%. That's down from the initially reported 1.6%. And here's where the breakdown came. Consumer spending was a little bit weaker, took 34 basis points out of GDP. Business spending, though, was stronger, but only added about 8 basis points because consumer spending is so much bigger. But it's still an export and inventory story. When you look at the big impact that both of those had on GDP in the first quarter, there's reason to think that maybe that will turn around. And the real final sales number, which a lot of people watch because it takes out the impact of exports and inventories, was up a strong still 2.8%, even though it was down a little bit from the initial report. Does suggest that the economy has some consumer strength behind it. Now, this R-star debate we've been talking about came up today because Bill Dudley, the former New York Fed Bank president, now Bloomberg opinion columnist, is writing that he thinks it might be higher. And we have heard from a number of Fed officials that maybe, or at least they're not ruling out the idea of a rate increase. The Fed is looking at a 0.6% R-star once you take away inflation, which implies a neutral rate of about 3.6%. So 5.25% to 5.5% is tight. Dudley has it the other way. With a 2% R-star, you get a 5% implied neutral rate, and Fed policy is not tight enough. And I would point to the Atlanta Fed GDP now for the second quarter. We don't have a lot of data in yet, but 3.5% is what they're saying, which would suggest that maybe the Fed might need to do more if inflation doesn't keep coming down.
So, I mean, Mike, I thought it was a great column by Dudley today. And my takeaway was there's no way the Fed really believes that the neutral rate is 3.6%. I mean, I know that's the published number, but surely they know that it's much higher. Otherwise, 5.25% would be super restrictive. And we continue to hit high after high in the stock market. We continue to get an economy that at least Atlanta Fed is forecasting growing at a 3% rate plus.
Well, I think that, Matt, they would agree with you that it is higher. The question is how much higher. And as Bill points out in his column, there's no real way to know because there's no way to measure R-star. John Williams, the New York Fed president, had put together with the late Tom Laubach an index of it, and they haven't been able to make it work right since the pandemic because the numbers got all screwed up. So the Fed is sort of flying blind on this. I would expect at the June 12th meeting they might revise their estimate of R-star, the neutral rate, higher a little bit, but I don't think they're going to go as high as you're talking about at this point. Interesting thing, we get to hear from John Williams today. Noon, he's speaking to the Economic Club of New York. We'll see if he says anything about this.
All right. Well, it's a fun debate, at least. Michael McKee, thanks very much for joining us. Let's get back to Jack Janasiewicz. He is portfolio manager, lead portfolio strategist at Natixis Investment Manager Solutions. And Jack, I wanted to know where you see opportunity in a market that has already run up so far, so fast. And as one of our Bloomberg columnists points out, you know, no one's buying these way out of the money call options right now. So even though everyone seems to want to get in, no one's betting on a huge rise in the future.
You know, and I think the key here is still going to be the interest rate backdrop, right? I mean, for us, large cap equities on the growth side still makes sense. But to get that sort of broadening out and market breadth, it all comes back to the interest rate backdrop. And I think you need to have confidence that the interest rate backdrop is going to move back down again. And that, I think, will spread into the mid-cap, for example, sector of the marketplace. And so, you know, it all comes back to the interest rate backdrop. That's the key to, I think, seeing a little bit of a shift underneath the surface. Until we get confidence that that's the backdrop that the market is getting in tune with, I think you're still going to be looking at large cap growth names being the leadership in here. You
need, I guess, then rate cuts to boost small and mid caps because they're, you know, most susceptible to floating. They have oftentimes floating rate debt, and so they're most susceptible to higher rates, right?
Absolutely, that's the case. And again, the key there is, you know, not only are they susceptible to floating rate debt, but they also probably have a little bit more financing needs that have to require coming to the market. So if rates are coming down, banks might have a little more risk appetite to lend because the economy might be looking a little bit better off. you're going to see the credit being extended there, and that's going to be the key for that small cap structure.
One wild card question here, Jack, because I see, before Natixis, you were at Duet Alternative Investments, and you focused on, at least in part, emerging market investments, as well as research into asset allocation. What do you think about emerging markets now? China's had an incredible run that no one seems to be noticing, and it could obviously be a flash in the pan. It could be a market that a lot of investors see as uninvestable. But what do you look at outside of the U.S.?
Yeah, the China story is very interesting, right? Significant bounce off the lows in here. And I think we think about this in terms of that distributional outcome, right? Left tails versus right tails. And, I think the market was really starting to price in potential for a significant left tail event, downside risk. And the more recent policy announcements coming out of China and the PBOC, they could try to put a floor underneath that left tail risk, so to speak. So it's chopped off maybe that downside risk, that significant 2 or 3 standard deviation move, if you will. And as a result, the market had to reprice that rate outlook or the risk outlook, which meant repricing stocks a little bit higher in here. The question, though, is do we continue to see policy coming from the PBOC and the Chinese to open up the right tail, which is the upside risk? To us right now, the incremental steps they're taking is more of a floor. I think we need to see more to see that right tail open up to get us more interested in emerging markets and specifically the Chinese equities there.
Right, and it could be there are risks there that a lot of investors just aren't willing to take. Jack, great talking to you. Thanks so much for joining us. Jack Janasiewicz there of Natixis Investment Managers Solutions. Joining us now with a look at some of the stocks that we're watching ahead of the opening bell here in the U.S. is Abigail Doolittle. Abby, what do you got?
Well, the plot's really thickening here, Matt, because we are looking at some pretty bearish action for the shares of Salesforce.com. And this, of course, after they guided to the lowest growth that they've seen in a few decades, even in history, 8% max for $9 billion, a little more than $9 billion. The question is this pressure from AI, or is this because the corporate IT spend may be slowing, and this is seen as nice to have technology? Now, if we take a look at some of the retail movers, on first glance, it seems very positive. Lots of green on the screen, but Burlington stores up 17%. They put up a massive beat, 30%, but that is a discount store. Birkenstock up 12%. That's clearly a niche city saying that their sandals that brand remains very hot. They beat top and bottom, but there's a 20% bearish short interest, so I would argue that's a lot of that gain. And then finally, speaking of discount spending, Dollar General up 1.3%. Bargain Hunters driving a beat there. Comp sales up 2.4%, better than expected. The CEO saying very strong traffic. So again, it seems as though there's some difficulty understanding exactly what's going on with the economy here, Matt.
All right, interesting stuff. A lot of interesting retail earnings out today. Abigail, thanks very much. We're going to talk more about retail, the earnings that are rolling in before and after the bell today.
What we're seeing in terms of companies and sectors, you can see those companies that cater for a lower income consumer actually doing well as you see a trade down of the middle income consumer.
We'll take a look at the retail landscape next. This is Bloomberg.
We have two sides of the consumer. We have the high-end consumer that continues to do extremely well, and you do see a lower income consumer that's struggling. But what we're seeing in terms of companies and sectors, you can see those companies that cater for a lower income consumer actually doing well as you see a trade down of the middle income consumer.
A slew of retailers reporting before and after the bell today, from Best Buy to Ulta Beauty. We'll be getting a better picture of the consumer as results roll in. Joining us now is Bloomberg's John J. Edwards III. He leads the U.S. consumer team. And John, I don't know how much better this makes the picture look, because I feel like Kohl's should be doing better, Best Buy should be doing worse, and we're getting kind of conflicting reports.
We are, yeah, and Kohl's certainly just does not seem to have it all together yet. They, continue to struggle. It's the 9th consecutive decline in comparable sales, and it really starts to look like a merchandising problem at the end of the day. They talk about their Sephora partnership, how that's bringing traffic in. but it doesn't look like people who are coming into Sephora are going into the rest of the actual Kohl's store to buy anything.
Yeah, I mean, here's my anecdotal take as someone who goes to both of these big box stores. Kohl's is where I go to return all my Amazon gear, and they should be well staffed to get me to keep buying stuff while I'm in there. They're not. Best Buy, on the other hand, I don't even know why I go there. They seem to usually have way too much staff, none of whom are doing anything at all.
Yeah.
So I can't believe profitability is increasing there, and yet it is.
Yeah, it is interesting. I mean, you continue to see sales declining there, down 6.1%, but they do cite their membership and their service offerings as boosting profits. So, the stock seems to be looking fairly okay for today.
What are we hearing from, Walmart and Costco are places that people who maybe shop at Whole Foods or DiCicco's will go to save money, right? Are we still seeing the consumer step down?
We are, yeah, and that's something that Walmart in particular is really putting a focus on. They're trying to get that higher income consumer, and in part by improving some of their merchandise mix. Some slightly higher end items, some improved appearance in some of the stores. And that is to attract that higher income consumer who is, looking for value as inflation persists.
I have to point out that Joseph Chaloff, our resident Westchester expert, says it's called DiCicco's, which is kind of like a hoity-toity grocery store expensive grocery store in Westchester.
Exactly.
But it's nice. What do we expect from Ulta Beauty?
They are, the beauty area has been an area of strength, and so, we'll look to see if they're going to continue to ride that, basically. It's they of course have their stores in Target locations, and so, again, there's been a lot of strength there. Beauty has been a standout area in retail, and so we'll see if, they're able to continue to capitalize on that.
All right. John, thanks so much for joining us. John J. Edwards III runs our U.S. consumer coverage. Now, another name we're watching today is Salesforce. We've been watching it since last night because shares have been plummeting. The software maker said sales growth will stall to its slowest in history. Joining us now is Bloomberg senior tech editor Dana Wollman. So, Dana, single-digit growth forecasts are not what we're used to from Salesforce, and now we're getting one.
Yes, absolutely. This is notable. This is this would be the slowest quarter, if it holds true, for the company in the nearly 20 years that it's been public. And for the past few quarters, the sales growth has been riding right above the 10% line, and this is where you see it possibly dipping below into the single digits.
It's interesting because Dell is doing so well recently due to its connection to AI, or the connection that they want us to believe they have with AI. I feel like Salesforce, especially with such a tech-forward leader like Mark Benioff, should be cashing in on AI right now. What's going on with that?
So the company has hinted that it does intend to introduce either AI products or work AI features into its existing products. I would say, though, that in general, software companies have been lagging hardware companies in the tech sector. It does seem that hardware companies, including chip makers, have had an easier time capitalizing on the AI boom than software companies, even big ones such as Salesforce.
So what are bullish analysts counting on from Salesforce? I mean, now, obviously, if the shares plummet, could be a good time to buy. What are the positives here in terms of their outlook?
I do think there is an appetite still for AI features, and I do think Salesforce is well positioned to capitalize on that. I do think that analysts are also looking for just still some core expansion. I know that Bloomberg TV, even earlier today, had on a guest who was concerned that the focus on AI, even just for AI's sake, which is sometimes seemingly what's happening in the tech industry, that the focus on AI for AI's sake is possibly coming at the expense of expansion. So just keeping an eye on the core business does seem to be top of mind.
All right, they need to basically focus on their bread and butter and not be too distracted by this sort of AI phenomenon.
Always, and it's such a tough, a fine line to walk. I don't think any of these companies, especially stalwarts such as Salesforce, can afford not to engage with AI. I think Salesforce risks becoming irrelevant if it doesn't work AI into its existing products or come up with something completely different that is very AI driven. But it does have this big core business at stake that it can't just let stagnate.
I mean, by the way, if 8+% growth is your slowest quarter in history, in decades of history, that's not too bad, right? And they didn't really miss by too much. What did they need to come out with to please analysts? Was it like just 10%?
I'm sorry, I don't have the number offhand.
But it was only fractionally higher that they needed to move, right?
It wasn't a huge miss. I do think the numbers did make Wall Street nervous. And as we have this conversation, the market hasn't yet opened, but we'll be very interested to see if those losses in the pre-market trading do hold, and if they hold all day.
Yeah, no, you're absolutely right. These things do change throughout the trading session. Dana, thanks so much for joining us. Bloomberg's Dana Wollman talking to us about really the big tech story, I think, in at least the early trade, which is Salesforce, the plummet after earnings yesterday, and we'll watch how it does at the open, which, by the way, is just 7 minutes away. Coming up, the morning calls. Then later, we're going to speak to Alex Chaloff, CIO at Bernstein Private Wealth Management, on why he's still bullish the S&P 500. This is Bloomberg. Time now for our morning calls. A look at some of the analyst recommendations on Wall Street this morning. First up, Mitsuho upgrading PayPal to a buy, pointing to strengthening traffic trends and an attractive valuation. Next up, JP Morgan upgrading Corning to an overweight, expecting shares to benefit as cyclical and secular tailwinds start lining up. And finally, Rosenblatt Securities downgrading Ciena to a neutral, seeing limited upside due to mounting competition and weakening demand. Coming up, we continue to see futures down. We're going to talk to Alex Chaloff, CIO at Bernstein Private Wealth Management, to talk about why he's still a buyer of the S&P 500. This is Bloomberg. This is the countdown to the open. I'm Matt Miller. Moments away from the start of trading, we are seeing stocks, futures that are still pointing lower for the most part. I will say we had slight revisions to GDP and personal spending that made the losses less, but we do still have yields higher, although not as high as they were before the 8:30 data. Those bells signify the start of trading. Let's take a look at some of the other assets we're following. Really, the yield is the important one here. 456.39 right now on the 10-year. Remember, just 2 sessions ago, we were at 444. So we've seen a little bit of a jump there, and that's a painful headwind for equity bulls. Euro dollar at 108 as usual, and NYMEX crude down about 75 cents to $78.49. 2 stocks to watch at the open are retail stocks, Kohl's and Best Buy. Demand remains weak for both retailers, but Best Buy's profitability overshadowed the slump in sales. Abigail Doolittle has more on these stocks. Abby?
And this is super interesting because we have the shares of Kohl's plunging, the worst day ever, going back to 1992. Really, really ugly here. Investors not liking this at all. And then on the other hand, Best Buy, to your point, they missed sales, and yet the stock is up nearly 10%, the best day since November of 2022. So relative to Kohl's, they really just missed right across the board. The most interesting thing, though, is especially as we're receiving so many different reports that consumers are looking for bargains, it was their clearance, the fact that their clearance items did not sell, that was what really helped to drive down or helped to drive the same-store sales comp miss. On the other hand, Best Buy, they missed sales, but that profitability up a little bit better than expected. So this stock up 10.6%. I would argue that for both of these stocks, a big piece of it is a short squeeze. For Kohl's, there's a greater than 30% short interest. For Best Buy, there's a roughly 10% short interest. So hurting Kohl's in a massive way and helping out Best Buy. But it's very puzzling what's going on with consumers here, these trends. It almost seems like Kohl's is falling into the category of Target, where consumers just sort of not quite going to that midpoint. They're either going really downstream or a little bit upstream in some cases.
I'm looking through, by the way, Abigail, albums that came out in 1992 were of the same era, and I noticed Dirt, Alice in Chains' Dirt, which is like classic and perfect from start to finish, and I'm sure you're a fan.
Alice in Chains was never quite my speed.
No?
But no. I'll stick with Led Zeppelin.
I recommend that you check it out. Okay, Abigail, thanks very much for that. Turning to tech. HP topping estimates and at the first increase in PC sales in 2 years, signaling a long-awaited rebound. This is kind of the hardware AI story, I'm guessing, that we've been talking about all morning. Alex Semenova is here with more. Alex?
Good morning, Matt. Well, indeed, those results from HP finally showing signs of a recovery in the PC market. Of course, HP and its peers had weathered a 2-year slump after consumers snapped up laptops during the pandemic and then retreated. It appears it's finally time for an upgrade. HP posting its first increase in PC sales in 2 years, also seeing second quarter revenue top analyst estimates. The business had been declining since May 2022 on a year-over-year basis. So these results showing a solid recovery, that even prompting upgrades from Citigroup and Morgan Stanley on its price target, both pointing to that robust PC segment. Morgan Stanley said that although the PC business is showing signs of growth, stabilization in the print business is the final hurdle for a more substantial stock re-rating. Bernstein analyst Tony Saganaki had previously said that HP was missing the AI pixie dust that some of its peers had enjoyed, like Dell Technologies. Though new AI PCs from HP could change that, the stock is up about 7%, the best day since April 2022, and the stock had been up about 9% year to date through yesterday's close. Matt.
But by the way, going low tech, Alex, I see Birkenstock shares are up 14% at the open, most on record. Apparently, they remain an incredibly hot trend. Do you have a pair of Birkenstocks?
I do not, Matt. I might have to buy a pair because apparently they're making a comeback.
It's a hot thing, you know? I mean, when I was a kid, everybody was wearing them, and then I hadn't bought a pair for the last 30 years until now. Alex Semenova, thanks very much for that. Let's turn to other software. Salesforce on track for its biggest drop since 2008 after forecasting the sales growth this quarter would be its slowest in history. Still, I think, 8+%, but that's too slow for CRM. Danita Sikova is here with more. Danita?
Yeah, what an ugly day for Salesforce. We saw a drop as much as 70%. And if we go to that year-to-date loss, it's now 15% in the negative territory. Obviously, this looks very ugly compared to what we see from hardware and chip makers, which have crazy gains this year. And then we have those software companies, many of them suffering. But investors are worried. Investors are worried whether Salesforce can stay relevant and investors being very focused about artificial intelligence and everything being artificial intelligence. Revenue forecast, as you said, is 8%. This is the first single-digit forecast they've had in 20 years since they have been public. So definitely big disappointments for investors there. That said, Salesforce have been trying very hard to make investors happy. They've been boosting their buybacks. They increased, they introduced a dividend. They have been talking about AI boosting revenue through new software, but that hasn't helped. The company is struggling year to date, and today is the worst day since 2008.
Yeah, still down 18% in the cash trade, so a rough day indeed for Salesforce. Anita, thanks very much for that. Turning back to retail, American Eagle drops after its net revenue misses estimates, but Dollar General reported stronger than expected sales and profit. Maybe not a great sign for the economy. Simone Foxman is here with more. Simone, consumers stepping down?
You know, it's hard to say. Really here, what we're seeing in the share movements seems to be a matter of where were investor expectations. So when you look like someone like American Eagle, you actually saw same-store sales up 7% year on year. That actually ahead of analyst estimates. But the expectations had been really high, and there was weakness, especially in American Eagle's Aerie brand. They also just reiterated their full-year guidance. One of the places they said was particularly weak was that swimwear category. category. And apparently, Bloomberg Intelligence kind of breaking things out. If you had gotten rid of Swim, their Aerie brand would have actually been up 11% year on year. And they did say they were seeing strong trends into the back-to-school season, but we're seeing the largest share drop since November. At the same time, you look at Dollar General's comp store sales, they were up 2.4%. So clearly, American Eagle doing better on a year-on-year basis, but the expectations had been super low. This is a turnaround story, but the CEO here talking about market share and gains. Citi pointing out that this was an overall uneventful report, but that costs were a little bit high. So we'll see about keeping those going, especially during the second quarter. One thing they mentioned is shrink. We're really not seeing a huge move, though we have turned a little bit negative, it looks like, in trading just these last few moments. But yeah, very puzzling picture of exactly what the consumer is doing.
So shrink is industry jargon for basically stuff disappearing. Maybe theft is another word you could use, although it doesn't have to be malicious. What's the story with shrink there?
Yeah, it's often things like theft. It's also, in addition to shrink, it's price mix. Dollar General has had a lot of problems with safety going back several quarters, theft and things like that. That likely the key bit there. But, we've seen various retailers really hit by shrink. They mention it and then their share price drops dramatically. I don't think we're seeing that so far, at least today, even though they did bring this one up.
All right, Simone, thanks very much. Simone Foxman talking to us about a couple more retail stocks. Joining us now for more on earnings is Alex Chaloff, CIO at Bernstein Private Wealth Management. And Alex, let me first get your take on, I guess the U.S. consumer is as good a place as any to start, right? Because we're so focused on the consumer now as inflation, hopefully dies down. Rates are so high. Prices, even if inflation slows, are still at a level that a lot of people find hard to make ends meet. So what's your view on the U.S. consumer?
Consumer's healthy across the board. From alternative data sources, we're seeing real strength coming from the consumer. You see continuation in growth in household balance sheets. There's been some volatility around it, but consumer's still strong. Labor market continues to be strong. That's really the secret weapon of this whole cycle, is the fact that the jobs market has been as strong as it is. And we continue to see that posting. So we are very confident in the consumer.
I wonder, right now, it's always great to talk about the consumer, but right now it really seems like business investment is super key. Torsten Slok at Apollo put out a slide the other day showing that the earnings expansion that we've seen is a great forerunner of higher capex 3 quarters out. And Bill Dudley today talking about the AI phenomenon that just continues to drive investment. Is that what it's all about, this market?
I think there's some of that. Our view is that companies are tightening their belts and bringing spending in. So we may see less B2B over the next couple of quarters. But again, back to the consumer, spending continues to be strong up and down the income strata. So it's not as if it's just the affluent consumer that's supporting the economy. This is really across the board. You've seen a good earnings season. I mean, that's the other thing I think gets missed in a lot of the days where there's a lot of back and forth and differences in the results. This has been a good earnings season that has affirmed the fact that the consumer continues to spend.
All right.
So in this cycle, I don't think it's company spending. I think it's still relying on the consumer.
All right. So you're confident in the consumer broadly across, the quintiles. What about earnings season? That strength, was it concentrated in the Magnificent Seven or any company that has to do with, AI, or is that broadening out as well, that earnings success?
It's a little bit of both, Matt. Can I have it be both? Is it okay to be both?
Both is okay.
Okay, good. It's both because, look, AI continues to be the leader. Thematically, we're leaning into it. Everybody's leaning into it. There's good reason behind that. There's strong support for those names as they continue to post really exceptional earnings result and give good guidance. I think part of what's got missed in the last few days in some retrenchment on broad markets is the earnings have been good. It's been the guidance that's been weak. So you're getting good earnings, good guidance from those AI names. But yes, to answer the second part of the question, you're also getting a broadening out. We've been talking about this whole forgotten 493 for the last I don't know, 9 months at this point, and that continues. So really good earnings across the board. Yeah, there were a couple of disappointments, but that's okay. You get that in a cycle. But broad strokes, really good earnings season.
All right, so analysts have been, raising their forecasts to catch up there. We've seen, strategists continue to boost their targets for the S&P 500. The most bearish strategists capitulating, finally throwing in the towel. Does that concern you? Because now everybody's on board.
I think, look, it's confirmation that we are really in a bull market. The fact that you have strategists suddenly ripping up their old piece of paper and saying, all right, fine, 5,600, 5,400, whatever it takes. That can be a contraindicator at times. But in our view, it's really just confirmation that this is a real bull market. And look, momentum's strong. Momentum is a very powerful factor, and it is full in play right now. So is it concerning? A little bit. But the fact, again, that it's happening in the midst of a very good earnings season, I'm okay with it.
So what do you like then right now, Alex? I mean, is active management really necessary now, or you just pile in to an index stock?
I would not be piling into a broad index today, because when you buy the index, as everybody knows, it's market cap weighted. You're getting last year's winners. The indexes are not a forward-looking instrument. They're very much a rear view mirror. Our view today is that, again, back to the 493, there's real value outside of the Mag 7. Well, I like Mag 6, but there's real value outside of those names as well. And active management definitely will pay off. I think everybody loves the S&P. Everybody loves large cap. Everybody loves growth. You got to give a nod to that and have exposure there. But if you want to be a little bit of a contrarian, look outside the U.S. Think about Europe, where any little shred of growth, of surprise, gets paid and paid and paid. And then I'd also throw emerging markets into the mix. I think a lot of people haven't really noticed because they've given up on EM and China. Those two areas have ripped of late. And so we continue to have confidence there.
All right, we've been talking a little bit about that today. What about private markets? I mean, yesterday we talked to the CEO of CalPERS, Marcy Frost. They're boosting their allocation to private markets. But also yesterday, Jamie Dimon said there could be hell to pay if something goes wrong there, and more retail investors are getting exposure.
Yeah, I think you've got to separate what's going on in the private equity markets from the private debt markets. And I think there is a real glut of capital in private debt. I think the headlines that are raising concerns, they are real. That's not just a lot of pomp and circumstance. There's a lot of money that have flown in there, and that's forcing some groups to make deals that we wouldn't do, that I think any decent underwriter wouldn't do. But because they have such a surplus of capital that they feel like they've got to put to work, they're doing some things that I think when we fast forward 2 or 3 years, you're going to look back and say, whoops, that shouldn't have happened. Good news is there's still a lot of dry capital from good investors out there that can buy those mistakes at a deep discount and generate really great returns for that next set of investors. But I think you've got to be really careful in private markets today. Love the opportunity. Love the fact that there's uncertainty in the public markets that's creating real opportunity in privates, but be careful.
All right, Alex, great catching up with you. Hope to see you again soon. Alex Chaloff there, CIO at Bernstein Private Wealth Management. Coming up, HP reporting increased computer sales as optimism rises for AI PCs. We'll have details on that coming up next. This is Bloomberg. HP, we used to call them Hewlett-Packard, reporting quarterly revenue that topped estimates, including the first increase in PC sales in 2 years. In case you've forgotten, those are personal computers. Carolyn Hyde, Bloomberg Technology co-host, is with me now. And Carolyn, for so long, it was like the PC is dead. I mean, Everybody has tablets. Your phone might as well be a computer as well. And now, I guess AI has driven a resurgence.
Yeah, and also remember, COVID, everyone bought up all they needed from a commercial perspective as well as a consumer perspective. So we just had a couple of years of wait and see. And now this whole AI PC, of which we just saw HP announce a new one at the Microsoft event last week, suddenly it's galvanizing some idea that we'll see increase in demand. What if this, overall, the CFO, CTO, and the key executives over at HP are saying, look, it's not going to immediately be a dominant force in our sales. It'll be about 10% for this fiscal year. But come the next few years, you might see up to 40-50% of all of the computers that they ship being these AI PCs using artificial intelligence at the edge on your own device. But look, we've finally seen a reprieve in overall commercial demand as well. That was where it was at for HP. Remember, printers are still down and overall revenue was down year on year.
Printers continue to be the bane of my existence and have been for 2 decades.
Mine too.
You co-anchor Bloomberg Technology with Ed something or other, and you guys cover AI every day, right?
Yeah.
ChatGPT obviously came out with kind of a fun app, and Bing has it. Now Google gives us answers with AI. But are people really using this technology? I mean, is it really gaining traction in terms of actual apps?
Well, it depends which industry group you're in or what particular sector you are. Look, if you're in HR, yes, you're using it. If you're in sales, you're probably using it. If you're customer service, I mean, we heard from Klarna, which is, of course, a fintech company, but they're saying about 70% of the overall workload that can be done by customer services can be done by AI, and they're not having to hire some like 700 or so people on the back of that. So, yes, it is being used. We actually ask a lot of our executives how they use it on a personal perspective. And look, it's so easy. When you're using WhatsApp, it's already integrated in there. When you're using Google, automatically you're getting your AI demand that way. I make up stories for my kids using generative AI. Everyone is adopting it in their own particular way, but I think already it's infiltrating. The problem is starting to dent certain companies that are talking up AI,
right,
but the overall businesses aren't wanting to spend in their direction. Think CRM today, think Salesforce. Look, they keep talking up their co-pilots. They keep talking about how they're the #1 customer relationship platform offering AI. But at the moment, the business community are like, I'm spending perhaps elsewhere when it comes to artificial intelligence.
It seems like it has to be on the hardware side, right? Because I would think CRM would gain a lot with AI, but I guess you have to have Jensen Huang actually mention your name before you can really benefit.
And you need, therefore, what Michael Dell's got at the moment. You need the focus that we get Dell's earnings after the bell today. And there has been, 6 straight days of gains in this stock. It is at a record high because we're all thinking not only will it leverage AI on the PC, and we can get a Dell PC at that, but it's also that they're selling more servers and they're selling more AI-related servers, something that's boosting their own ability, particularly as we've got more Jensen's actual GPUs, able to buy them, able to see the supply side of them. So yes, Dell's going to do particularly well. At the moment, for a Salesforce, for example, we still want to see where's the actual revenue benefit. You're talking a good game, but where's the spending on your AI offering?
All right, Caroline Hyde, thank you so much for joining us. Great to get a preview of Bloomberg Tech. She co-anchors Bloomberg Technology with Ed. You can catch that at 11 a.m. New York time. You'll get more insight into tech, plus an interview with C3 AI CEO Tom Siebel. That, again, is at 11 a.m. New York time. I'm Matt Miller. This is Bloomberg. All right, it is time now for a look at your trading diary. This is what you should be watching throughout the day as we see futures, or sorry, they're not futures anymore. We've been trading for 25 minutes. As we see the cash trade down just about 0.25% on the S&P, about 1/3% on the NASDAQ 100. In terms of your trading diary, we get April pending home sales at the top of the hour, so watch for that. Plus Fed speak today from Williams and Logan, and a number of retail earnings after the bell today. We've been talking about retail all morning, and we'll get a continuation of that. Then finally tomorrow, we get the all-important inflation data point, PCE, as well as personal income and spending data. So for your Fed watchers, tomorrow is really going to be the big data day. Just type EcoGo on your Bloomberg terminal to get all of that. This was the countdown to the open. I'm Matt Miller. This is Bloomberg.